Welcome back. You're with us on Trading Hour. We are now focusing on the auto sector. A report by ICRA says that the domestic commercial vehicle industry's uptrend is likely to be arrested in the current financial year amidst moderation in economic activity in some sectors due to perhaps the general elections and some overall slightly tepid trends. We have with us Kinjal Shah, Senior Vice President and Co-Group Head Corporate Ratings at ICRA. Kinjal, it's good to have you on. I was just looking at the note that you folks put out, and you're expecting that for, I think, medium and heavy commercial vehicles, there's actually going to be a decline in volumes, 4 to 7% decline. So, where's the sense of caution coming from?
Let me just take a step back and go to some history. So post the pandemic, if you see, the CV industry witnessed a sharp growth in volumes in FY22 and 23. So around 26% in FY22 and roughly around 34% in FY23. So this created an enlarged base for the industry. Now on this high base, the growth momentum overall for the industry did witness a slowdown in FY24, and it ended with a 1% YOY growth. And our expectation is that the overall CV industry would witness a decline of around 4 to 7% in FY25, as you rightly mentioned, because of the moderation in the economic activities in certain sectors in the backdrop of general elections. Now, coming to the M&H CV industry. So this industry, which is largely 7.5 ton and above segment, that accounts for around 33% of the total CV industry. And this industry witnessed a flat growth in FY24. And we expect that it will witness a decline of around 4 to 7% because primarily the end user of this segment is the infra segment, primarily the cement sector, steel sector, etc. So here in H1, at least we expect that there would be a YOY decline in volumes because of the slowdown in the infrastructure activities during the election period. H2, we do expect that there would be a YOY growth in volumes. However, our estimate is that the growth in H2 will not be adequate to compensate the loss in H1, and that's why we would see this decline of 4 to 7% overall in FY24.
Okay, just to get this right, this is not a high base effect problem. You're saying the moderation in activity and largely because of elections, or is there more to it than the usual, election-related slowdown in ordering?
So typically it's perceived that during the election period that the monthly model code of conduct sets in, and during the election period there is a slowdown in the infrastructure activities, and typically the sectors which are connected to the infrastructure activities that would typically see some slowdown during this period. That's why our understanding is that Q1 and overall H1 that would see moderation, and H2 we would start seeing a rebound in the activities and sub growth.
But Kinjal, if you are mentioning that the growth in H2 will not be enough to compensate for the losses in H1, do you believe, is that a continuation of the sluggish trend in demand in general? Because in that case, if there is already a lack of demand in the first half, which is causing the volume contraction, the demand would slightly improve, but still not as much as the first half or as the previous years have been.
Yeah, so typically, I mean, if you see the CV industry is cyclical, and like I mentioned, FY22 and 23 saw very high growth, and FY24 we reached overall volumes at around 9,67,000 odd units, which was just below the peak in FY19 of around 10 lakh units. So the base itself has become very high, and because of that cyclicality, we would see a period of slowdown which would stem in, and this would coincide with this period of the general elections. So both these combined, we expect that would see result in moderation and that growth in FY25.
Okay. Kinjal, just hold that thought. We are just also looking at some numbers that we've got from the mutual fund industry, and that's a massive inflow number. I think the net equity inflow number 30.